Universal banking. A universal bank is made up of a number of distinct elements. The first is commercial banking, concerned with the borrowing and lending of money. The second is investment banking, which is concerned with helping companies access the equity and debt capital markets. The third element is market making, providing derivatives to clients to help them manage risk, broking, the matching of buyers and sellers, and prime brokerage, which involves sophisticated trading systems to hedge fund managers. The fourth element is bank assurance, asset management, also known as investment management, and the provision of pension insurance services. The final section is custody. This is the deep back office of a bank, ensuring that trades are matched and settled, and keeping a register of who owns what at the end of the day. So let's look at commercial banking in a bit more detail. Arthur has just been paid. Arthur deposits his money with the bank. As the money is transferred to the bank, so the amount will appear on the bank's balance sheet as a liability. So Arthur has deposited his money in the bank. But while he may think in terms of deposit, he has in fact lent his money to the bank. So what does the bank do with that money? It lends it to Ben, who uses the money to buy a house. As the money is lent to Ben, so Ben will appear on the bank's balance sheet as an asset. So the bank will pay Arthur, for example, 3% to borrow the money from him, and will charge Ben, for example, 6% to borrow the money from the bank. The difference between the rate at which the bank borrows money, in this case 3%, and lends money, 6%, is known as the net interest income. This is in effect the gross profit for the commercial bank. The bank can also borrow additional funds to lend out by issuing bonds. Again, as the money is lent to the bank, then, just like Arthur, these will appear on the balance sheet as a liability. Banks can also borrow and lend to and from each other. And that is essentially what commercial banks do. As well as lending to individuals to buy houses, banks can also lend to companies. Sometimes companies will use these funds to buy other companies. For example, they will use the loans to fund acquisitions. Banks can also facilitate trade finance. If Arthur is in the UK and wants to buy a container of plastic ducks from Charlie in India, then Arthur may be reluctant to pay for the ducks until they arrive, and Ben may be unwilling to ship the ducks until he is paid. Essentially, the bank can act as a middleman and facilitate this trade through trade finance. If Ben wants to borrow 100,000 from the bank, then this may not be a problem, but if Ben wants to borrow 100 million, then the bank may need to get a group of banks together to lend the money. This is called syndicated lending. If Ben wants to borrow a significant amount of money to purchase an asset, such as an oil rig, then the bank might choose to buy the asset directly and so secure the loan on that asset, thus reducing the risk to the bank associated with the loan. And this prevents Ben from borrowing the money to buy an asset and then finding that he uses the loan for something else. And finally, if Ben wants to build a significant project, such as an airport or shipping port, again the bank can use project finance to fund the initiative. Here the bank lends the money to the project rather than to Ben, and the revenues from the project are used to repay the bank. Like asset finance, this is a way of reducing the risk associated with significant loans. So now let's look at investment banks. Investment banks provide access for their clients to the debt and equity capital markets, flotation on the stock market, and issuing bonds on the bond markets. Corporate finance is primarily concerned with advising clients on mergers and acquisitions and assisting with how these deals might be financed, borrowing money via acquisition finance or issuing debt and equity. The existence of the primary market, where companies issue shares and debt for the first time, will only operate with the existence of the secondary market. I will only buy a share in your company if I believe that I can easily sell that share. Investment banks therefore have a concern with the function of the secondary markets and thus become market makers. Principal finance is where banks take a stake in the deals on which they are working. essentially betting the bank's own money. Investment banks also provide their clients with derivative services, acting as the counterparty to clients who are looking to use derivatives to manage risk or to trade. Banks will usually offset these positions with other clients or banks in the market. Banks also provide broking services, matching buyers and sellers in the market and thus ensuring the liquidity of the secondary markets. Sometimes banks cannot find a buyer at the exact time that the client wishes to sell, so the bank will purchase the security with a view to offloading it at a later date, hence the existence of an equity sales team in banks, this being a form of short-term proprietary trading. Asset management involves looking after and investing vast sums of money. Pension funds and insurance companies are major contributors of capital to the markets, and fund managers will help to ensure that these funds are invested in the most lucrative areas. Custody is the deep back office, which ensures that all trades are matched and settled, disputed trades are sorted out, and registers of share and bondholders are all kept up to date. Important, especially when a company pays a dividend to the shareholder or a coupon payment on a bond. And so we can see how the universal banking model aims to provide a full suite of services to their clients, from depositing and lending money to accessing the capital provided by pension funds and insurance companies, and ensuring the liquidity in the markets to keep the clients trading. Back in the 1920s, the distinction between commercial banks and investment banks was not so distinct. Commercial banks were allowed to use depositors' money to buy shares as well as to make loans. This was all well and good when share prices were rising, as they were in the 1920s, but in 1929, in the Wall Street crash, share prices plummeted. This meant that banks were unable to repay their depositors, resulting in a run on the banks, causing banks to go bust and plunging the USA into the Great Depression. And the rest, as they say, is history. In order to prevent this happening again, the commercial banks were separated from the investment banks. The Glass-Steagall Act was introduced in the early 1930s. This separated commercial banks from investment banks, effectively saying that banks could either take depositors' money and use that money to make loans, or they could assist their clients in accessing the debt and equity capital markets, but not both. In 1999, after 70 years of relative financial calm, the Glass-Steagall Act was repealed. This allowed large commercial banks such as Chase Manhattan, the largest commercial bank in the USA at the time, to merge with JP Morgan, a major investment bank, to create JP Morgan Chase & Co. And that is the universal banking model.